Welcome to the Deep Dive. Today, we're looking at a really fascinating story coming out of the facility services world. We're talking about ABM Industries Incorporated, following their Q4 2025 earnings release.
And it's a fascinating one because it's a real paradox.
It is. The call dropped pre-market December 17th, and the headline number, adjusted EPS, was a huge miss. Almost 20% below what everyone was expecting.
But the stock rallied. It jumped more than 5%.
So our mission today is to filter out all that financial noise and figure out what operational nuggets convinced investors this was actually a strong quarter.
It's a perfect case study in looking past the headline.
Yeah.
Because if you just look at the pure numbers, you get two completely different stories. On the one hand, record revenue.
How much?
They hit $2.3 billion, which, handily beat the street's estimates. That's really robust growth, 5.4% year over year.
And the organic growth was solid too, right?
Very solid. Organic growth, so from the existing business, was 4.8%.
Okay, so that's the operational beat. That's the good news. But then you have that major financial miss. Adjusted EPS came in at what, 88 cents?
0.08 cents against an expected $1.10. It's a huge shortfall.
And usually a miss that wide would send a stock tumbling.
Mm-hmm.
So what did management say was the single biggest reason for this divergence?
Well, they were very clear on the call. They said the core business performance was actually ahead of their own expectations. The entire miss, they argued, was down to a single non-core financial item that just dramatically distorted the results.
So an accounting adjustment, not an operational failure.
That was the argument, yes.
Okay, let's unpack this financial noise. Because for you, the listener, to understand why this stock rallied, you have to understand why a 26-cent per share negative impact was basically ignored by the market.
Right. It all stemmed from a prior year self-insurance adjustment.
Self-insurance.
Yeah. So ABM has this large self-insurance pool. It's about $500 million. It covers things like workers' comp, auto, general liability claims. In Q4, they had to book a negative impact of $15.8 million against adjusted net income. This was to adjust the reserves for claims that came from prior years.
And that one item was the sole cause of the miss.
The sole cause.
I have to play devil's advocate here. Management is asking investors to just ignore a 26-cent EPS miss. When a company changes how it accounts for risk, especially a $500 million pool, how do we know this isn't masking some deeper structural issue?
That's a fair challenge, and they were careful to add context. They pointed out that on a pool of that size, $500 million, a 4% volatility is actually well within industry norms for a company with over 100,000 employees.
So this kind of adjustment isn't unusual.
Not at all. And what's changed is the accounting. Following recent discussions with the SEC, they now have to report this adjustment above the line in their non-GAAP earnings. So it's not a new business problem. It's just an old, historically volatile expense that is now much more visible.
I see. So the volatility was always there. We just couldn't see it in the adjusted number before?
Exactly. And to give a cleaner view, they introduced a new metric.
This is really important for looking forward.
It is. They're calling it segment operating margin. And it does exactly what you'd think. It strips out the noise from those insurance adjustments. It lets you see the true core profitability of the services they're actually delivering.
And what's the guidance for that new metric?
For fiscal year 2026, they're guiding to 7.8% to 8.0%, which is basically flat to slightly up, versus the 7.9% they saw in FY25.
So that's the stability benchmark the market latched onto.
That's it.
Okay, so the business is operationally sound despite the accounting mess. But what's driving that impressive 4.8% organic growth? Let's get into the segment performance.
The growth engine, without a doubt, is Technical Solutions.
ATS.
Their high-value segment.
The highest value, yeah. And they had a phenomenal quarter. 16% revenue growth overall, with 11% of that being organic.
And what's in that segment?
We're talking about complex, forward-looking stuff, microgrids, mission-critical infrastructure. The margins there are great, too. Segment margin hit 12.4%.
That double-digit organic growth in the highest value part of the business is, that's exactly what you want to see. But it wasn't all perfect. Manufacturing and distribution, M&D, it grew a solid 8% organically, mostly from new tech contracts.
Right.
But the margins there got squeezed. They dropped from 10.4% down to 8.6%. That's a big drop.
It is a big drop, and management addressed it head-on. They called it a strategic pricing decision.
Meaning they're cutting prices to win business.
Essentially, yes. They're taking lower margins in the short term on some of these high-tech contracts to, get their foot in the door and build long-term sticky relationships.
Is that a good trade-off, though? Or are they just trying to buy growth? The bet is on the lifetime value of that customer. You win the first contract, maybe at a lower margin, but then you're in. You can expand your services over time into higher margin work. It's a calculated risk.
Okay. We also saw some good news from aviation.
Yeah, aviation grew 7%. That's just fueled by travel trends continuing to be positive. Plus, they won a major new passenger services contract at a big global airport.
And that's set to ramp up soon, right?
Second quarter of fiscal 26, so that's coming online.
And importantly, the legacy parts of the business seem to be stabilizing.
That's key. Business and industry, BNI, which is all the office buildings and commercial real estate and education, both saw 2% growth. Management actually said the commercial real estate challenge is now behind us.
A bold statement.
A very bold statement, but it suggests the worst of the decline is over.
So stabilizing the legacy core frees them up to focus elsewhere.
It frees them up to focus on the future, on integration and high-growth acquisitions.
Which brings us to the foundation they've been building. Let's start with the internal fixes, the ERP system.
Right, that ERP implementation caused them a lot of friction earlier in the year. Fixing that back-end system had a massive immediate impact on cash flow. Free cash flow in Q4 was $112.7 million, a huge turnaround.
And what about collections?
Days sales outstanding, DSOs, were down 11% from their peak. It just shows that operational stability delivers real cash.
Okay, now for the really exciting part, the external pivot. The acquisition of WGNSTAR for $275 million in cash.
This is not just another small bolt-on deal. This is the big strategic swing.
What do they do?
They're very specialized. They provide managed technical workforce solutions specifically for the semiconductor and high-tech manufacturing industries.
And this scales ABM's presence there immediately.
Hugely. Once this deal closes in Q2 of 26, ABM's annual revenue from the semiconductor space will be around $325 million.
The strategic logic here seems pretty compelling, especially with all the talk of U.S. semiconductor onshoring.
It's a massive tailwind, and management made a comparison that you really need to pay attention to.
What was that?
They compared the potential of WGNSTAR to their highly successful RavenVolt acquisition.
RavenVolt was their microgrid play, right?
Yes, and it now generates over $400 million a year for them. That comparison is the highest possible endorsement.
So what does WGNSTAR give them that they don't already have?
Access. ABM traditionally operates in the outer ring of a facility. WGNSTAR brings the certifications, the technical expertise to get into the inner ring, the actual fabrication centers, the fabs.
And that's a huge untapped market.
Enormous. It's only about 15% outsourced right now. So they're positioning themselves to capture that growth.
So they're buying their way into a closed ecosystem where growth is practically guaranteed by these huge national capex cycles. But let's slow down and look at the financials of the deal itself. It's not immediately accretive, is it?
No, and this is a textbook example of a strategically sound deal that is initially dilutive. They're funding it with cash and debt, so you've got about $12 million a year in interest expense and another $13 million in amortization. So from a pure accounting perspective, it will be modestly dilutive in fiscal year 2026.
A short-term accounting hit for a long-term operational gain.
Exactly. And we're pretty certain about that gain because of the margins in this space. WGNSTAR operates at mid-teens EBITDA margins.
Very high.
Very high. And because of that, plus the cross-selling synergies they expect, the deal is projected to be meaningfully accretive in fiscal year 2027.
How much?
Adding about 5 to 7 cents to EPS. The market looks straight past the FY26 accounting noise to that FY27 reward.
And that clear path to accretion plus the strong core performance is why they're so confident in their outlook. Let's run through the FY26 guidance.
Management is forecasting total revenue growth of 4-5%. About 1 percentage point of that is from WGNSTAR.
So the core business is still targeted for 3-4% organic growth. That's strong.
It is. And the bottom line guidance, when you strip out all that noise, implies really robust profit growth.
The adjusted EPS number.
They're projecting $3.85 to $4.15, and that's before any future insurance adjustments. If you normalize the FY25 number, this guidance implies core EPS growth of over 10%.
That's the kind of number investors want to see from a company in transition.
Absolutely. And they're backing it up with capital allocation, record new sales bookings of $1.9 billion.
But leverage is going up.
It is. It'll approach 3.0 times post WGN-STAR, but they're balancing that with shareholder returns. They reduced the share count by 4% in FY25 and just announced a 9% dividend increase.
So when you put it all together, it becomes really clear why the market reacted the way it did.
The investment community just read the tea leaves. They completely ignored the earnings quality noise because they prioritized the operational quality.
And the strategic pivot.
And the definitive strategic pivot up the value chain.
You're not just looking at a facilities management company anymore. This is a move toward being an integrated industrial tech support provider.
Focused on mission-critical services. Microgrids, data centers, and now semiconductor fabs.
All areas supported by these huge long-term capex cycles. Management is clearly trying to evolve the portfolio into what they called a higher growth organization.
And that strategic shift justifies the rally.
Speaking of strategy, it's time for our segment where we discuss some market possibilities. And remember, this is purely theoretical, for discussion only, and it is absolutely not financial advice.
Right. So the strategy we just outlined fundamentally repositions ABM. But the consensus multiple on the Stark probably still reflects its old identity as a traditional lower growth service provider.
It's treating it a discount.
Exactly. And this WGN-STAR deal gives them high-margin, early mover exposure to a secular growth market that should command a premium.
So if the market has mispriced the speed of this evolution, what's the aggressive but plausible trade?
Our plausible but outrageous trade pitch is a long position in ABM 18-month out-of-the-money call option.
So what's the rationale?
The rationale is a fundamental re-rating of the stock's multiple. We think that could materialize in late FY26 and into FY27. The payoff happens if ABM successfully integrates WGNSTAR and the technical solutions segment keeps posting high growth numbers. That proves the shift is real, and the multiple should expand beyond typical services sector norms.
Which would give significant leverage to those longer-dated calls.
A lot of leverage. It's a bet on execution.
A bet on execution. And as a final thought for you to chew on, management explicitly compared WGN-STAR to RavenVolt. RavenVolt, which focused on microgrids, scaled into a $400 million business in just a few years.
Now, just consider the potential scale if they can replicate that success, if they can use WGN-STAR's capabilities to do in the much larger, more restricted semiconductor market what they did with RavenVolt. Well, the size and quality of that business unit would fundamentally change the entire company profile, far beyond what I think investors expect today.
So record revenue, a clear strategic shift to higher value technical solutions, and a lot of confidence heading into FY26 despite some accounting noise.
That's the story.
That is the core takeaway from this deep dive. Thank you for joining us as we explored ABM's strategic pivot, and we hope you continue to explore this very dynamic industry.